So let's look at long and short in a little bit more depth. So long is buying a stock or index, a bullish trade. You're expecting the price to increase in value. Now, the way that CFDs are structured, the more the price rises, the more you will profit. It's not a simple binary event. In other words, if it goes up, you make X amount. If it goes down, you lose Y amount. The fact is, with a CFD, you're making more the more you're correct, basically. So if you're betting or if you're trading on the stock going higher, so you're going long, then for every increment it moves up, you are going to be making money. It's pretty much exactly like buying a stock, buying a bunch of shares. For every 1%, 2%, 5% move that makes, you're making that amount on your initial investment. If you're buying £10,000 worth of stock and the thing moves up 5%, you've made, or the value of that stock has gone up by 5%, and so your stock is now valued at £500 more than what you bought it for. And obviously, if it went up 10%, it would be valued at £1,000 more than what you bought it for. So it's an incremental increase in profit the more you go. So if you're right and the stock doubles, then you're going to double the value of your asset. Whether that is a stock, and it could be an index, it could be a it could be a currency pair, commodity, anything like that. So what about going short? Now, going short is ultimately just the opposite. It's selling a stock or an index, or again any underlying asset. It's a bearish trade. You're basically looking for the price to fall. Now, you're selling something you don't own and buying it back later to make money on down moves. So this is not selling. In other words, you're not saying that you've already got control of the stock and you have some and you're selling it. No, this is different. This is basically like you have nothing at all, no position whatsoever, but you're deciding that you want to profit from a falling market, a falling asset, a falling share, falling stock, whatever it may be. So what you do is you're going short. So what is going short and how does it work? Now, when you first come across this, you kind of think, what? How do I sell something that I don't own? It makes no sense. If I don't own it, how can I sell it? But this is kind of what happens, in a long-winded way when you're going short. In reality, it's instant. So when I talk through this process, don't think it's like a CFD. You're not writing out a full contract and signing it in duplicate, triplicate. Someone's verifying your signature if they want to place a trade. No. It's just pre-authorized, it's pre-arranged, but ultimately this is the process that's happening. So how does it work? So you're effectively borrowing the stock. So you're going along to somebody and going, hey, I would like to borrow 10,000 shares of Facebook, please. And someone says, yeah, no problem at all. We've got a charge for that, but we'll talk about that in a second. They say, so you say, thanks very much. I'll take that stock and I will sell it into the market and I receive cash for that because I've sold stock to somebody else in the market. Now, again, I'm talking from a perspective of we're trading directly in the market. If we had a CFD layer on top of this, we would have a contract for difference based behind this, and it would just be a contract based on the difference as opposed to going short. But this is ultimately what you're doing if you are shorting the naked stock or the underlying asset directly. Just so we get our head around how this all works, because often you just look at it and go, it's really confusing. So you're taking this 10,000 shares of Facebook, you sell it into the market, and of course you're going to get a bundle of cash for that. But, you don't actually have that cash. You still got to pay back that stock. So what you do is you then, later on, you say, okay, I want to buy that stock back now. So you use that cash and you buy back the stock. And there's going to be a difference in the price of valuation of that stock. It might have gone higher, in which case you're going to have to use more cash to buy back the same amount of shares. Or it might have gone lower, in which case you have to lose less cash to buy back those shares. And you return that stock to your broker and you keep the difference. So let's talk about some actual values here. So let's say you want to short 400 shares of Admiral Group. Okay, good insurance company UK. Your broker says, okay, no problem at all. Here's your 400 shares. Thank you very much. And you say, right, you go to the market, you sell your 400 shares in the market, and they're currently trading at 20,000 pence. No, it's not 20,000, is it? It's 2,000 pence, but that is £20. Now, this is where you can get confused because UK shares are always quoted in pence. So you look at that and you say it's 2,000, it's £20, 20 pounds, 2,000p. So you're selling that and you're receiving £8,000 in return. But you still owe your broker the 400 shares, of course. You can't just take your 8,000 and run off and say, yeah, great, I've made £8,000. No, you're still owe your broker. So what you do later on, you say, you know what, it's dropped down now. It's down to £19 or 1,900 pence. And of course, the total value of that for the 400 shares is only going to be 7,600. So you pay the 7,600, you buy your 400 shares back, you give the 400 shares back to your broker. He says, thank you very much. You pocket the difference, which is 8,000 minus 7,600 because you have to pay less to get those shares back. And then your broker's going to want some fees for that. And there's going to be a daily charge on that depending on how hard the stock is to borrow and all those kind of things and those prearranged things. Now, of course, if you're trading a CFD, it is literally a contract between the difference. So ultimately, you are saying, I want to sell 400 CFDs. And the broker says, sure, the current price of that is 8,000. And then when you buy them back, the current price is that. But you've already got a contract that agrees that he's going to pay the difference between those two. So he's going to give you for the £400 in your account minus any fees that you have to pay. So one thing just to note very quickly before we move on here is that you've got to be very cautious when you're shorting, because now listen, if you're shorting stuff like the FTSE or the Dow or the DAX or big things like Apple and what have you, some of the big stocks, it's not an issue at all. This does not come into play. But as you start to go into smaller instruments, specifically stocks, or shares, sometimes they're hard to borrow. So sometimes you might have identified a really great shorting opportunity, but you know what, you can't do anything about it because it's impossible to borrow. And that just means if your CFD broker says it's hard to borrow, it means that they can't borrow it, because ultimately, a good broker is actually mirroring your CFD as a stock trade in the underlying market, but just packaging it for you as a CFD, but just becoming market neutral instead, so he's not got any risk. We'll talk about more about picking the broker, that if you can find a market neutral broker, then you're onto a winner. And also, there's heavy borrowing costs. So again, these are dictated by the people who are loaning out the shares. So if we're going really deep into this now, which we may as well as we're here, the stock, people who are loaning you the stock to sell short obviously own the stock. Now, generally speaking, they don't care about the short-term fluctuations. And us as traders, we're looking to profit from these short-term fluctuations, so we do care. So you've got these pension funds or investment funds, hedge funds, whatever, who have got a multi-year view on this stock, but they'd like to earn a little bit of money. So they say, yes, you know what, you can borrow my stock and you can loan it out to go and short, but I want X% per annum for the ability to do that. So it's just adding, they get a little bit extra for it. They can loan it out, get a bit extra, get some dividend payments, but they don't care ultimately that it's affecting the short-term valuation because they're looking at a longer trade thesis than we are as short-term traders. But if there's a lot of demand for the short, like if you go back to some examples, Tesla, we had Snapchat at the IPO, trying to think of some others, but there's just scores of them. Sometimes the borrowing costs are extortionate. They can be almost like 100% per year, 50% per year, stuff like that. So you've got to be careful. If something's looks like a great short, you've got to think of how long am I going to have to hold this for and how much it's going to cost me each night to borrow this. We'll go into some more depth about actually calculating this kind of thing, but it's something you've got to look out for. If you're an avid short seller and you want to get on the short side of stuff, just be cautious of that. And the other thing you've really got to be careful of is it can be recalled on smaller instruments, and not just smaller instruments. And what does that mean? If you can imagine, there's a load of people short and all of a sudden the market starts pushing to highs, and then the people who have loaned out the stock, the funds, say, you know what, I want that stock back now, please bring it back to me. And they've got the right to do that because it's their property. So they'll say to the broker, I want all those shares back now. The broker will say to you, we have to call in those shorts, you have to give the stock back, and that's going to cause additional buying pressure. You may well be in a loss position, but you have no choice. You've got to give that stock back immediately. And that sometimes that's just a strategic thing done by the people who own the stock. And sometimes it's just literally that they want it back because they want to sell it themselves. All sorts of reasons. So you've got to be a little bit careful of that and keep your eye out for what's going on there.